Welcome to Module 14 of Accounting 5000. In Module 14 we're going to begin Chapter 7. We're going to talk about presentation of current liabilities. In Module 15 we'll continue by talking about long-term liabilities. So we're going to break this chapter up into two parts, the first part being current liabilities. Let's think back to what we had in the previous modules, Modules 1 and 2. We talked about the definition of what a liability was. Remember, liability is the probable future sacrifice. So this is something we're going to have to give up in the future. And we define it as something we owe, something that we're going to have to pay in the future. We also said that it usually has the word payable at the end of it. So it could be an account payable, a wages payable, etc. So these are probable future sacrifices that we're going to have to pay in the future. When does a company incur a liability? Well, think about what companies do. Typically they're running their business, and most businesses are fairly cyclical. In other words, they up and down over time. We talked about the toy store making most of its sales between November and the end of December. In order to maintain their sales staff, their building, they may have to borrow money short term during the year to keep their operations going until they can generate revenue in November and December. Those short-term debts are current liabilities. Those are the things that we will have to pay within 1 year or less. Typically they're things like notes payable if they are less than 1 year, accounts payable, which are the bills that we owe our suppliers when we purchase the goods in our retail store, and wages payable when we owe money to our employees and we're going to pay them in another time period. You can also have accounts like taxes payable, interest payable, anything that's due within a year that we owe, and it probably ends in the word payable. Those are current liabilities. Now, things that are not liabilities, that's an important facet for you to understand, is that not everything that we have goes on the accounting records. Remember, one of the drawbacks we talked about in accounting is that not everything is recorded in our books. For example, if we're negotiating a potential loan, that does not go in our books. If some of our assets have increased in value or the cost to replace them has increased, we still do not enter that in our books. That is not a liability that we owe. Additionally, if there are lawsuits outstanding where customers or other people have sued us and want money, but we have not had a judgment against us, that is not something we owe, so it does not go on our books as a liability. We call those contingent liabilities, which we'll discuss in greater detail in the next module. But as a general rule, the things that have not been settled do not appear on our books. Short-term debt, then, typically is based on the fact that we are going to pay it within a year. Now, some of those debts that are short-term are due more recently, sooner, than other debts. So we categorize our current liabilities on the balance sheet in the order in which we're going to have to pay them, with the ones that we'll have to pay the soonest being at the top of the list. So we have things listed under the order in which they're due in the current liability section of our balance sheet. In other words, how soon is it due? Now, one of the things that a lot of companies incur in their short-term liability section is what's called a working capital loan. Just like we were talking about this toy store a minute ago, a company will go out and borrow money short-term to cover their expenses up until the time that they will start generating revenue again. And they will have additional cash flow in order to meet their obligation. Typically, this is just a regular note in which they sign that they owe some money, but it will only be for a month, 2 months, or 3 months. That's a note payable. Another type of debt you see in a lot of companies that's short-term is called a revolving line of credit. In this case, a company goes to a bank and establishes the fact that they can borrow money short-term on a revolving line of credit in which they will pay it off as they can. They will incur more debt as they need to. And it's sort of like a credit card. They will pay off the amounts they can. They may have a balance or they may have paid it all off. It's called a revolving line of credit. Another term you may hear when you're dealing with liabilities in banks is the term prime rate. Theoretically, prime rate means that this is the rate of interest that a lender will charge to their most creditworthy customer. So if you're a good customer and you have a good credit rating, you often will pay a low rate of interest. But the bottom which you will pay is called the prime rate. There's some established prime rates that are published in the financial sections of the newspapers. The London Interbank Exchange rate, the Wall Street Journal rate, these are called prime rates. Most of us would not qualify for a prime rate when we're borrowing money, in which case we would pay something like prime plus 1, which means we'll pay the prime rate plus 1 additional percentage point. So if the prime rate is 5%, we would probably end up paying something like 6% interest. So that's what they mean when they talk about prime rate. It's the most creditworthy customers with the least risk involved who will pay the lowest amount of interest. Other things that show up on the short-term debt side of the balance sheet are discounted loans. Now that's an interesting concept. What happens in this case is that when you borrow money, you don't receive the face value of the loan. You receive less than the face value because the bank or the lending institution has removed the interest from the amount they're going to pay you. In other words, they've received their interest ahead of time. We call that a discounted loan. A lot of student loans are discounted loans. I know that when we borrowed money to go to school, we borrowed $1,000. That was the face amount of the note. But we actually received in cash a little over $900. So the bank had deducted their interest before they gave us what we call the proceeds. The proceeds of that loan were $900 and some, but the face amount of the note was $1,000. The difference was called a discount on the note, and that's like prepaid interest, if you want to think of it that way. It's prepaid interest. That discount will have to go against interest expense as the life of the note goes through a course of business. So those proceeds being less than the face value of the note means there is prepaid interest, and that's additional interest that we will pay on the note. The discount becomes part of interest expense. Some other types of short-term debt that you will see: current maturities on long-term debt. For example, if you buy a car, you often make payments for more than 1 year. Well, 1 year would be current liabilities because you will be paying those within the next year. The rest of those payments would be long-term debt because you're going to be paying them more than a year from now. So that's another type of short-term debt that will appear on your balance sheet. A final component that you need to know out of this chapter is the fact that when we make purchases, we often give a discount to the seller if they pay early. We call that a discount or a purchase discount, and we record it when they actually take it in most instances. In that case, we call it the gross method. Under the gross method, what we do when we make a sale is we debit the revenue that we receive, and we credit the payable for what they owe us. And then if they pay early, we enter the difference between what they paid and what they owed us as a discount, a purchase discount. Most companies, like I said, use the gross method. A few companies will use what's called the net method. In the net method, what companies do is record the sale and the amount that's owed to them after they've deducted the discount, assuming that everybody who is going to buy from them will take the discount. That's not always true, and if they don't, they put it in an account called discounts lost. You can see a comparison of those two methods in your textbook on page 234. In one of the boxes of your textbook, they go through the distinction between the gross method and the net method. I would imagine that most of you would encounter the gross method in your real life situations. So that's the one I would be most familiar with. An additional type of short-term liability is called unearned revenue. Let's think of some instances when this would occur. Unearned revenue occurs when you charge your customers ahead of time for things they have not received. For example, if you sell season tickets to the ETSU basketball games, then ETSU would have unearned revenue until they actually began playing those basketball games and earning that revenue. That would be a liability to ETSU, because if they did not play the games, they would have to refund money to the season ticket holders who purchased those games. If you have to refund the money if an event doesn't occur, that's a liability. So we've talked about sporting events. The other times when you will see unearned revenue will be with magazine companies, where you pay a subscription for a year, and each time you receive a magazine, part of that unearned revenue becomes revenue. Deposits. Often when you order a specific special part, you have to make a deposit for that part, and until it comes in, it is a liability to that company, because if they don't get the part, they have to refund your money. So deposits are often called unearned revenues. These are any revenues you've collected in advance, but you have not done anything to earn them yet, but you're hoping that eventually over time they will become revenue. So if you're looking at the journal entry for unearned revenue, if you receive the cash, that's going to increase cash asset with a debit, and it's going to increase your liability, which would be a credit to increase a liability of unearned revenue. As you earn the revenue, you would debit the unearned revenue to decrease the liability, and you would credit the revenue account to show your increase in revenues. So it's a fairly simple accounting process, but it is very worthwhile for companies that have large amounts of unearned revenue. For example, magazines, newspapers, sporting events that have large numbers of dollars that they haven't earned yet but are on the books as a liability. A few other things you may encounter in the short-term liability section of a balance sheet are what we call accrued liabilities. These liabilities come about because some expenses are put on the books as you actually recognize them. For example, we talked about wages payable. That would be an accrued liability for your payroll. Payroll taxes payable would be the taxes that you had to pay on the payroll, but you're going to pay it in the future. Two others would be warranties. Anytime you sell a product and you expect that not everything will be perfect with those products and you're going to have to repair them, that's a liability for the company. So the company will have to show a warranty liability. Property taxes. Typically you only pay your property taxes once a year, but they are valuable to you throughout the entire year. That's a liability, and you will pay it within 1 year. So that would be a property taxes payable account. Notice all those short-term liabilities end in the word payable, except for unearned revenue. Let's do a little practice on these short-term liabilities, and let's use exercise 1 in your textbook as our first example. Exercise 1 is in your book on the top of page 256. This is about a note payable with a discount. On April 15th, notice the date, 2004, Powell obtained a 6-month working capital loan from the bank. The face amount of the note signed by the treasurer was $300,000. The bank is going to charge an interest rate of 9%, and the bank made the loan on the discounted basis. Calculate the loan proceeds that will be available to Powell and show how it's entered into the accounting records. Well, the first thing you're going to do is calculate the interest on the $300,000. That goes back to our I equals PRT formula. Interest equals the principal times the rate times the amount of time. The principal is $300,000. The rate is 9%. And this is a 6-month loan, so 6 months is 6 months out of 12 months in a year. So the total amount there is $13,500. Now the bank is going to keep that $13,500 as prepaid interest, or the discount. So all the company will receive is the $300,000 minus the $13,500, or the proceeds would actually be $286,500. To enter that into their records, you increase the asset of cash with a debit to cash of $286,500. You increase the liability, the note payable that you owe, with a credit for $300,000, and the difference is that discount on notes payable, which is a debit of $13,500. During the life of the loan, you will be debiting interest expense and crediting discount on notes payable to reduce that discount until at the end of the life of the note, the discount is 0, and it will just show note payable at $300,000. In Part B, it says calculate the amount of interest expense applicable to this loan during the fiscal year ended June 30th, 2004. Well, they signed the note on April 15th. So from the 15th of April to the 30th of June is 2.5 months. Half of April, all of May, all of June. So to calculate the interest on the note for those 2.5 months, you take the I equals PRT formula, 300,000 times 9% times 2.5 for the 2.5 months over the 12 months in a year. That gives you 5,625. Finally, in Part C, what is the amount of the current liability related to this loan that would be shown at the end of June 2004 on the balance sheet? Well, it would show the $300,000 loan minus any discount. Well, the original discount was $13,500, but we've reduced that $13,500 by the $565.25 that we show in Part B. So our discount is less than that $13,500. So we actually end up on the balance sheet with $292,125 being shown as our current liability for that loan. Well, let's do one more like that. Let's look at problem 2 right below there and do another one. On August the 1st, 2004, Colombo Company's treasurer signed a note promising to pay $240,000 at the end of December in 2004. The proceeds of the note were $232,000. So now you know the face amount of the note and you know the proceeds, so you can compute the interest. And that's what they ask you in the Part A. Calculate the discount rate used by the lender. Well, first you have to know the interest, and you simply take the face amount of the note minus the proceeds, and that gives you the discount of $8,000. Well, if you know that your interest is $8,000, remember I, interest, equals PRT. The principal is $240,000. We do not know the rate, but we know that there are 5 months from the 1st of August through the end of December. So we know that our time factor there is 5 over 12. So if we solve for the question mark, or the rate on the note, we would come up with 8% interest. Part B, it says calculate the effective rate of interest on the note. Well, we're only getting, in our hot little hands, $232,000. But we're paying $8,000 worth of interest on that. So using our I equals PRT formula, we can calculate that over the 5 months, we're actually paying 8.3% interest on the note. So that's the actual percentage rate. You may notice that some banks, when they advertise, show you a percentage rate and then they show you the actual rate. The actual rate on a discounted note will be higher than the amount we use to calculate the discount. Finally, in Part C, they ask you to use the horizontal method to show the writing of the note, the receipt of the cash proceeds, and recording interest, and then repaying the note. To do that, to actually show the signing of the note, you're going to receive cash of $232,000. Cash is an increase, so you would debit cash to show that increase. You're signing a note for $240,000, so you're going to credit notes payable, increasing your liability $240,000. Remember, you had a discount, so the discount is going to be a debit of $8,000. Now, what about the interest expense? Well, part of that $8,000 is going to become interest expense over the life of the note. So using your I equals PRT formula, you take the principal amount of the note, which is $240,000, multiply it by the 8%. 1 month is 1 over 12, so you get $1,600. So you credit the discount to reduce it, $1,600. You debit interest expense, you're increasing an expense account with a debit of $1,600. You would do that a number of times until finally, when you actually paid off the note, there would be no discount. It would all have become interest expense. And what you would actually do is get the note payable off your books. So to reduce the liability, you would debit notes payable, $240,000, and you would credit cash, because you're going to pay off the note, credit cash by reducing it $240,000. Let's do one more problem dealing with unearned revenue, because I think that's an interesting type of event that actually affects a lot of companies and affects individuals also. So let's use problem 8 near the top of page 258 of your textbook as an example. We have a theater here that sells season tickets for 6 events for $42. For the 2004 season, they sold 1,200 tickets. Use the horizontal model or write a journal entry to show the effect of the sale. They're going to receive cash, $42 from each person times 1,200 people, so they're going to get cash of $50,400. But they have done nothing to earn this $50,400. So that's a liability to the firm. To increase the liability, you credit it. In this case, you credit unearned ticket revenue. In Part B, they ask you to show the effect of actually presenting an event. If they're presenting an event, they're going to actually earn part of that money. Well, how much are they going to earn? Well, if there are 6 events, and they're $42 for the total price, that's $7 per event. So you would take $7 times the 1,200 tickets they sold, and you would actually have earned $8,400. So you reduce the amount of your liability, your unearned ticket revenue, and you do that with a debit of $8,400, and you increase your revenues with a credit of $8,400. Finally, in Part C, it says, where on the balance sheet would the account balance representing the funds received for performances not yet presented be classified? As we said, that's a current liability. They're going to produce those events within the next year, so those are a current liability. So what we've done in this module is to go through and look at current liabilities, things that you owe on a short-term basis, less than 1 year. We're going to continue with Module 15 and finish up Chapter 7 by looking at long-term liabilities.